Welcome to our deep dive on trust dissolution payouts and the tax bills that can follow. In this video, we'll clarify when trust distributions are taxable, how Schedule K-1 drives your actual liability, and how payouts may affect your AGI and MAGI. We will also cover practical steps you should take before depositing funds, and we'll close with key takeaways. Let's begin by outlining today's agenda, and then we'll move into why these details matter so much. Here's our roadmap. First, why this topic matters. Second, we'll break down the difference between principal and income. Third, we'll explore the crucial K-1 form. Fourth, we'll connect distributions to your AGI and MAGI. Fifth, we'll cover steps to take before depositing money. Sixth, we'll use diagrams to visualize all of this. Seventh, we'll test your knowledge with quick quizzes. Finally, we'll summarize and include an important disclaimer. Now, let's transition to why this topic really matters. Trust distributions often feel like windfalls, but the tax treatment depends on whether the funds are principal or accumulated income. Misunderstanding this can cause underwithholding, unexpected tax bills, and MAGI-related consequences like reduced healthcare subsidies or lost tax credits. With that urgency in mind, let's transition to the most critical distinction: principal versus income. A trust distribution can be treated as principal or accumulated income. Principal typically represents the original assets held in the trust and is generally non-taxable to you as the beneficiary. Accumulated income includes interest, dividends, and realized capital gains earned by the trust. These amounts are taxable when distributed. The essential point is that the character of the money, principal versus income, determines taxability, not the fact that it came from a trust. Next, we'll see how you actually know what you received. The Schedule K-1. This flowchart starts with the trust dissolving. The trustee, or their legal counsel, determines the character of the funds and the trust's distributable net income, then issues a Schedule K-1 to the beneficiary. At the decision point, if you receive principal, it's generally non-taxable and does not directly increase AGI. If you receive accumulated income, it is taxable to you, increases AGI, and likely increases MAGI, which can influence subsidies, deductions, and credits. A side note highlights that if income is retained within the trust instead of distributed, it may be taxed at high trust tax rates, which is why trustees often distribute income to beneficiaries. Now let's look more closely at the K-1 itself. The Schedule K-1 from Form 1041 is the authoritative document indicating what income, deductions, and credits a trust passes through to a beneficiary. It breaks out the character of the items, such as interest, dividends, and capital gains. If the K-1 shows taxable income allocated to you, that amount increases your AGI and likely your MAGI. You should not estimate blindly. Request and review the K-1 before you make decisions about depositing or spending the funds. Next, to make this more concrete, let's scan a quick cheat sheet of typical K-1 items. This table lists common K-1 categories. Interest income, dividends, and capital gains generally increase AGI. Some items like tax-exempt interest might not increase AGI, but can still be included in certain MAGI calculations depending on the program. Deductions and credits may offset income or pass through, depending on context. With this in mind, let's connect these items to real-world consequences by exploring AGI and MAGI effects. When taxable trust income increases your AGI, it often increases your MAGI as well. This can alter healthcare subsidies for marketplace plans, potentially affect Medicare premium surcharges, trigger phase-outs for certain deductions and credits, and impact other means-tested benefits. These ripple effects make planning essential. To visualize how trust income fits into the bigger picture, let's look at a pie chart of typical AGI components. This pie chart shows an illustrative composition of AGI. While wages or salary may represent the largest portion, trust income from a K-1 becomes an added slice that increases total AGI. Even a relatively small trust income slice can push you into phase-outs or new surcharge brackets depending on your overall picture. Next, let's compare what happens if income stays in the trust versus being distributed to you. On the left, income retained in the trust is often taxed at highly compressed trust tax brackets, which can lead to higher taxes. It may avoid immediate AGI or MAGI impact for the beneficiary, but can be less flexible for beneficiary cash flow. On the right, distributing income to the beneficiary typically subjects it to individual tax rates, which are often lower than trust rates. However, distributions increase the beneficiary's AGI and likely MAGI, potentially affecting subsidies or credits. This illustrates why trustees often prefer distributing income and why beneficiaries must plan for the resulting tax and MAGI effects. Now let's translate this into concrete action steps you can follow before you deposit any funds. First, request the Schedule K-1 and all distribution details. Second, verify exactly how much is principal versus income. Third, estimate your tax liability and MAGI impact with a tax professional or accurate software. Fourth, set aside enough cash to cover the expected tax. Fifth, consider making or adjusting quarterly estimated tax payments if necessary. Sixth, coordinate timing with your trustee and CPA if you can manage the calendar. Seventh, keep all documents for your records and for filing. To see how these steps unfold over time, let's view a simple timeline. This timeline places key actions across a typical year. In the first quarter, you receive the dissolution notice and request the K-1 and distribution details. In the second quarter, you review the character of funds and estimate the tax and MAGI impact. In the third quarter, you set aside funds and adjust estimated payments if needed. In the fourth quarter, you file your return using the K-1 and consider planning for the next year. The recurring theme is to avoid depositing or spending funds before you know their tax character. Next, let's illustrate the roles involved using a sequence diagram. This sequence diagram shows how the beneficiary requests documentation from the trustee. The trustee provides the K-1 and allocation details. The beneficiary shares these with a CPA, who models the AGI and MAGI impact and estimates tax due. If necessary, the beneficiary makes estimated tax payments to the IRS and coordinates timing with the trustee before the distribution is executed. The CPA then helps file the return with the K-1. The diagram emphasizes documentation and timing at every step. Now it's time to test your understanding with a short quiz. Quiz question. Which part of a trust distribution is generally taxable to the beneficiary? Options: A. Principal. B. Accumulated income like interest, dividends, or realized capital gains. C. All trust distributions are tax-free. D. None of the above. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Accumulated income, such as interest, dividends, or realized capital gains, is typically taxable to the beneficiary. Principal, or corpus, is generally non-taxable. Now let's move to a second quick question. Quiz question. Does a distribution categorized as principal increase your MAGI? Options: A. Yes, always. B. No. Principal generally does not increase AGI or MAGI. C. Only if you spend it. D. Only if the trustee files late. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Principal generally does not increase AGI, and therefore it does not increase MAGI. The key is accurate, timely documentation to confirm what portion is principal versus income. Next, let's ground this with a quick case study example. In this example, a beneficiary receives $80,000 from a dissolving trust. $60,000 is principal, which is generally non-taxable. $20,000 is long-term capital gains, which is taxable to the beneficiary and increases AGI. This likely increases MAGI as well, and might affect healthcare subsidies, surcharge brackets, or various phase-outs. The prudent approach is to set aside enough cash to cover the tax before spending the funds, and to consider estimated payments to avoid penalties. Next, let's visualize the types of distributions and supporting documents with a mind map. This mind map centers on the trust distribution. One branch shows principal, generally non-taxable, and representing original assets or unrealized growth. Another branch outlines accumulated income, interest, dividends, and realized capital gains, which is taxable to the beneficiary. The documentation branch highlights the Schedule K1 and supporting allocation details, while the impacts branch points to AGI, MAGI, and potential changes to subsidies or credits. Before we wrap up, let's include a short Markdown cheat section you can screenshot for reference. Here is a concise checklist you can reference at any time. Request the K1 and allocation details, verify the character of the distribution, estimate your tax and MAGI impact with a professional, set aside cash for taxes and consider estimated payments, and keep thorough documentation for filing. The key reminder is that the character of the distribution determines taxability. Now, an important disclaimer before we conclude. This content is for educational purposes only and does not constitute tax, legal, or investment advice. Your situation is unique. Consult a qualified tax professional and rely on official documentation, including your Schedule K1 and the trust agreement. With that noted, let's summarize the key points. Key points. Trust distributions are not automatically tax-free. Principal is generally non-taxable, while accumulated income is taxable. The Schedule K1 dictates what's taxable, and therefore affects AGI and MAGI. Income retained within the trust can face punitive tax rates, which is why distributions are often made to beneficiaries. Plan before depositing by requesting the K1, estimating your taxes, and setting aside funds. Now, let's finish with a brief wrap-up. In summary, identify whether your distribution is principal or income, demand and carefully review the K1, model the AGI and MAGI impact before spending, coordinate with your trustee and tax professional, and maintain thorough documentation so you can file confidently. Finally, here's a closing note and a call to action. Thank you for watching. If you found this helpful, please like the video, share it with anyone dealing with trust distributions, and subscribe for more practical financial guidance. Post your questions and experiences in the comments, because your story can help others. See you in the next video.